just talked about master budget, a forward-looking view of the company. In chapter 4, and that was chapter 10, 11, 12, and 13 don't exist. Chapter 14, 15, and half of 16 talk about flexible budgets. Kind of a backwards-looking view of the budgeting process. How did we do? And where did we do well, and where didn't we do well? We'll get through 14 and 15 today, and we'll talk about 16 next in 2 weeks. As we showed here, we want to get from the budgeting, the master budgeting process, to understanding variances. What worked and what didn't work. And you want to there are 3 purposes for the budgeting and variance analysis. 1, well, the master budgeting, the purpose is to look forward. The variance analysis is for control purposes, that term control purposes. We'll see more of that here, whether it's performance evaluation or just taking remedial actions to solve a problem. And we'll also see that you have to do this variance analysis or something called absorption accounting. Have you talked about absorption accounting in other classes? Where fixed costs have to be absorbed into the cost of products or individual products. And so you need to do a variance analysis potentially for full absorption costs as an accounting purpose. And then we'll finish up by saying, this is all great, but in fact, you know, if you're just looking at short-term results, financial results, you're selling your company short, and you need to think about non-financial indicators to understand how you do it. So the flexible budgeting variance analysis process is a control process. You're essentially monitoring activities and determining whether you're achieving the goals of the company. And achieving the goals means achieving the strategic goals and your operational operating goals. The 5 components that you'd want to control are: 1, have you hit the sales volume you said you'd hit? Have you sold for the price you said you were going to sell for? Have your variable costs per unit matched what you said they were going to be? Have your total fixed costs been equal to or less than the fixed costs? And then finally, sales mix. You'll see that sometimes you could sell more product, but if you're selling the wrong product, it could be bad. So is your sales mix the appropriate sales mix for maximizing profitability? We just talked about the master budget. We know what it is. You budget these items: sales volume, sales price, variable costs, and total fixed costs. And in fact, through that, you're also budgeting your sales mix because you're saying sales volume by product, so you create your sales mix that way. Okay. Remember this slide a little bit? We started off this course talking about process costing and job costing. We talked about volume-based, activity-based, and I threw in departmental assignment of overhead. And we talked about actual cost measurement, which no one uses, normal cost measurement, which is generally used, and I put off talking about standards. Today we'll talk about a standard costing system. Standards are what it should be in an efficient operating environment. They prescribe describe your expected performance. You expected to use 3 pounds of aluminum to create whatever that product was in the last chapter. That is your standard usage of aluminum. We need to differentiate between standard costing and standard costing systems. Lots and lots of companies, if not all, use standard costing to create their master budgets. Whether or not you create a standard costing system, which puts an accounting focus on it, is up to the company. Some do, some don't. Do you account for the standard costs or not? It doesn't matter whether you're a job costing environment or a process costing environment. You could use standard costing in either. You could use it in manufacturing and service companies and not-for-profits. And the standard cost sheet specifies the standards for all of the cost elements. And so here's an example from the text of the standard cost sheet. And for whatever reason, it has a mistake in it. Text. So to produce product XB1, you need 4 pounds of aluminum, 1 pound of PVC. That's your standard quantity. You have a standard cost per unit. And therefore you have a subtotal on your cost, all shown on your standard cost sheet. Direct labor, number of hours, overhead, broken down into variable overhead and fixed overhead. And mistake on this sheet. So you have 5 hours of fixed overhead allocated out per unit. Obviously it's fixed, so per unit has to be calculated. We'll talk about how you calculate that. At $24 per unit, that's 120. And somehow that should be 122 if you want to change that sheet. Somehow became 180. And then you added the variable selling administrative expenses. So when you come up with these standards that you'll use for standard costing, there are different ways of coming up with standards. And we kind of talked about them the last. You can have an ideal standard, a perfection standard. And if you do everything right, that's how much it should take. If you don't create any scrap, you'll only use 3 pounds of aluminum. If your workers are working efficiently and getting the job done, it'll take them an hour to do the job. That's an ideal. Will it ever be reached? No. So you're building in the chance of you're building in the fact that you're never going to reach that. What's the advantage of using an ideal? I call it the Rex Ryan effect. Right? At the jet fit. Everyone know who Rex Ryan is? He's the coach of the New York Jets. He's kind of bombastic. And like last year, he made the mistake, I guess, of saying, we're going to the Super Bowl. Or something to that effect, right? Well, what was he really doing? He was setting the target, burning the lifeboat, and saying, let's go for it. Now, they didn't actually come close, but the theory of doing that is you have a better chance of getting to that target if you do that than if you don't. What's that? Well, he does it every year. Now, at some point, it doesn't matter whether we laugh at it. At some point, and I think it's the same for an organization. The organization stops listening, right? But if you could do it, if you could motivate the organization to try to reach that ideal, if it works, then it's a way to improve the organization. So it has its purpose, but you have to expect a variance out of that because you're not going to reach it. Or if you do reach it, you know, congratulations. It's been 42 years since the Jets have reached it. So, but I'm not bitter. Okay, that's the ideal standard. It has its place. Then there are continuous improvement standards. We talked about that event where, okay, so our standard in January will be 3 pounds, but we think we can improve our processes through the year with the new product that we're just starting to build, and it's going to be learning curve, both people and materials. And we can improve in the course of the year, so we'll have a continually improving standard over the course of the year. And then there are currently attainable standards, kind of fair standards. We know we could do this, but maybe doesn't get the organization working quite as hard as they should be to improve upon it. Maybe a little bit too soft. So different types of standards, and standards are set authoritatively or participatively. I think it goes without saying that a participative standard with its buy-in from the people who have to actually implement it will have a better likelihood of success, but it also has the potential to become a softer standard that's easy to obtain, so it's a give and take. Quite often unions in a union shop define the standard. You can't force the people to work any faster than what the union agreement says they need to do. So how do you establish standards? For direct materials, it's based upon the combination of quality, quantity, price, and timing. If you use a higher quality material, maybe you need less of it. So the very first step is to say, what's the quality of material that's appropriate for the product? And then you derive the quantities you need from that quality. If you're producing a Rolls-Royce versus a Honda, maybe they're the same size car. At the moment, for the Rolls-Royce, it's maybe going to have quarter-inch thick body versus a Honda will have an 1/8 inch thick body, whatever. So the amount of material will be driven by the quality that you're trying to get at. And then you can figure out the pricing and the timing based upon your vendor relationships. For labor, it's based on the type of work they're performing, complexity, skill level, and learning curve, potentially, condition of the equipment, and wages. Condition of the equipment. So as you figure out your standard labor costs, you have to think about the equipment. If you're using older equipment, it might take more labor hours. That's the trade-off. And this is where industrial engineers might come in. Time movement surveys. Actually watch employees working, and you come up with a standard based upon watching the activities. So you have industrial engineering, management, accountants, and the employees, everyone comes up with a standard. Clearly, unions are involved in this. And once that's all done, the personnel department defines wage levels and benefits. This is how you establish the standard costs. You may or may not have what I call the standard cost system, which takes it from a management tool to an accounting tool. As an accounting tool, you enter journal entries in the course of the period, the course of the year, based upon the standards. As things happen during the year, variances occur. Those variances are then reflected as additional journal entries, showing what your differences from standard. So at the end of the year, you get everything right. And you have details that allow you to see standards versus variances. So you may or may not use standard and flexible budgets and master budgets for an accounting purpose. That's the choice of the organization. You will likely use it for financial control purposes. Okay, so we talked about standards, talk about flexible budgets now. So you know that your activity is below your budgeted activity. And when we're going to come up with these terms, favorable and unfavorable variances. Unfavorable means you're below what you wanted it to be. But if you sold less, you'd expect that variable costs would go down equivalently. Right? But did they go down enough? You don't know. So you want to be able, by just by looking at your master budget, you don't really know how well you've done in each of the categories versus the budget. You just know you sold less than you expected, and therefore you didn't have the bottom line that you hoped for. Flexible budgeting and variance analysis allows you to really dig in and understand. So, the question that you want to follow with that is how much of an unfavorable variance is due to the lower activity, the lower sales, and how much was due to inadequate cost control somewhere else. You have to break it down. So to answer that, you do something called flexing the budget to the actual activity. So as you'll see, what that really means is you hold everything else at standard, but you change your activity level from your budgeted activity to your actual activity and see what you would expect it to have happen. That'll tell you what your revenues and costs should have been. And by doing this right, we can use it for operational control and performance evaluation, kind of one and the same. And again, if you're using a standard costing system, you would use it for financial reporting as well. Another name for a flexible budget is a control budget. It's backward looking, whereas the master budget is forward looking. The flexible budget is backward looking, normally on a monthly basis. As I said, you use the actual sales volume, still using the budgeted or standard selling price and variable costs and fixed costs. And that allows you to start the process of variance analysis. Now, we're going to, for today, we're not going to think about sales mix. We'll just think about one product. Sales mix adds a few different interesting twists to it. We'll talk about that in a couple of weeks. But we'll talk about fixed costs and variable costs, both overhead and direct. Okay, Schmidt Machinery. They were budgeted at sell 1,000 units. Expected to sell those units for $800 per unit. So they were expecting to have revenues of $800,000. This is the master budget. They expected their variable costs to be a total of $450. So their variable costs were $150,000, leaving a contribution margin of $350,000. They expected total fixed costs, it's just a single line, doesn't matter, per unit, to be $150,000. So they expected to earn 25% or $200,000 off of $800,000 of sales. That was what they budgeted. They came up short. They only sold 780 units. So their revenues, these are all given. The end of the period, they can count, right? They earned $639,600 in revenues. That was actual. Their variable costs, at the end of the period, they can count. $350,950. The contribution margin was $288,650. The fixed cost, remember, was supposed to be $150,000. It was $160,650. So their income was $128,000 compared to the $200,000 that was in the master budget. And now you have to start asking questions. Is it because they sold less, or is it because their fixed costs were out of control? Maybe their variable costs were out of control. You know, maybe they sold it for a different price. We don't know exactly where it came from. We can be pretty sure that the fact that they sold, 220 units less than expected is a contributor. But we don't know how much that contributes versus other items. Could be a lot of things. Maybe they had poor price control with vendors. Maybe bad accounting. Maybe it should have been 160, but somebody made a mistake. It could be as simple as that. It could be they needed to have an unexpected purchase somewhere. So it could be a lot of different things. We'll talk about what the components of the fixed costs are, and we'll try to decide. We don't know exactly what might have caused it. But just because they're fixed costs doesn't mean that they can't be surprises. Right? The concept of fixed cost just says it doesn't vary based upon the number of units sold. So whatever these additional costs were, we're assuming it was not related to the fact that there were additional units sold. Yeah. So at the highest level, we can start looking at the variance. In an unfavorable, because it's less, 220 units sold. We had unfavorable, because it's less, revenue. We had a favorable variable cost. But we don't know whether this is really favorable or not. Why don't we know whether this is favorable or not? Yeah, you sold less than you expect your variable costs to be less, but was it more or less than the ratios state it should be? Contribution was less. Again, you expect that you sold less. Fixed assets were less, resulting in 72,000 less than we want. This still doesn't tell us a whole lot. So the process of variance analysis is a constant decomposition of these numbers, digging in and understanding what's causing the variance.
So the reason for distinguishing the unfavorable and favorable is whether it is that or not. We have to distinguish.
We distinguish unfavorable and favorable.
That's the reason why we want to.
As we'll see, even if you have a favorable variance, it's worth looking into Favorable variance could be caused by something unfavorable somewhere else. You need to understand. But we need to look at it whether it's favorable or unfavorable because ultimately these items need to add up to this, a total unfavorable variance. So this unfavorable 160 and this favorable 99 creates this unfavorable 61. Okay, almost like a plus and a minus. So questions that management could be asking, I don't know, could. Why was operating income less than expected? Why have expenses gone from 75% to 80% of sales? Why did you have that 10,000 more in fixed costs? What contributed to the disappointing results? And then you can look at your categories. Was it the volume? Was it the price? The variable cost variance? Was it material or otherwise? I'm sorry, was it material or was it from the labor? So you break it down from direct material to direct labor. You also care whether it was material. Was it a big enough one to look into? So that's not. And then you need to understand your fixed cost variance. In theory, if it was seasonal, you would have reflected that in your master budget, and you wouldn't have variances because you would have reflected the seasonality in your forward-looking budget process, and then you would still get to be good. This is looking for the non-systematic changes. Okay, so a general model for doing variance analysis. For each one of those variances that we saw, favorable or unfavorable, we really want to break each one down. Understand, was it due to price, or was it due to a quantity variance? Did you sell it for more or less than you should have, or pay more or less for the item? Or did you require more of the direct materials than you wanted, or less? Or did you sell more or less than you thought? Now, this is where the analysis really meets the road. The price variance is you look for total amounts based upon the difference between the actual price and the standard price. The totals between the actual and the standard. And for quantity variances, you look for the difference between the actual and standard quantities. And that'll make more sense on this next slide. Again, this is the general model. So your price variance is you take the actual quantity times the actual price. And that's really the actual amount that you took in. You compare that to the actual quantity times the standard price. The difference between the two is the variance that was due to a price change.
Well, what's the standard price? How do you get this?
At the beginning, let's go back to what we talked about for the master budget. Last, chapter 10. You were buying aluminum. The standard quantity was 3 pounds per unit, and the standard price was $2.40, let's say, in April. So it's what you determine to be the appropriate price for aluminum in your process of coming up with a standard. That's the analysis that you do before the period.
The actual price is now.
Actual price is what you actually paid. It was aluminum is a commodity. There was a run on aluminum. It's now $2.55. When you thought it was going to be $2.40. And so you're comparing actual quantity versus standard price. Yeah, well, let's look what we've actually done here. This standard quantity times standard price is what's on your master budget, right? This actual quantity times actual price is what you actually have. So using the price variance and the quantity variance, you can break down the results into two categories when you're comparing the actual versus the master budget.
Yeah, I'm not clear. The actual price that original cost versus
That would be actual cost. Let's take the direct material. That's the actual cost of buying that direct material in bulk. I mean, we're talking about $3.65 per unit. We spend, instead of spending $200,000, we spend $25,000 on a unit in this period. Okay, so it's the actual cost. The actual
selling price to that item.
If it sells, yes. If it's direct materials, it's fine. Yes. Okay. We're going to go through a lot of examples, a lot of this stuff. If it's still a concern, after a couple more slides, let's keep talking. Okay. So the standard quantity, as I said, is the quantity that should have been used for the volume reduced. This is on the slide, which you see a lot right in your text. And we're going to go through this slowly. But the idea is you start with your master budget. And then using flexible budgeting, you decompose your results to understand the causes of your various variances. And you decompose to very detailed level, direct labor and direct materials. And we'll talk chapter 16, chapter 15 talks about overhead variances, which is a little bit different. But you start to decompose, and you're always decomposing into they're called different things depending upon the item. A price variance and a usage variance. That's what we call it for direct materials. Labor rate, which is the same as price, versus efficiency, which is the way usage. Okay? Let's dig in. Okay, so how do you calculate one of these? What we're just talking about. You begin with the master budget. That's been done. You then determine your actual sales. Your actual sales volume. You then take your standards for all of your items and compare them using the actual sales volume. You do that for all your variables. Your variable revenues, your variable costs. And then for fixed costs, this is where you make a decision. If your sales volume is reasonable, and you get to define reasonable as a manager, you just use your fixed costs from the master budget. You say, okay, there are variances in fixed costs that we can't manage anyway. But if it's unreasonable, then you might use the new fixed cost levels and ignore the master budget's fixed costs. Okay, so this is what we just said on the previous slide. Remember that we thought that we were going to have 1,000 units sold, and we only sold 780 units. We expected to sell our units this period at $800 per unit. That was our standard. If we go all the way back, we'll see that was our standard. Remember, we expected to sell 1,000 units at $800, which got us $800,000 in sales. So that was $800 per unit. So based upon the $800 a unit, we would have expected to have 624,000 in sales. Our variable costs were $450 per unit in the same way. So we would expect it to have had 351,000 in variable costs at this sales level. Our fixed costs, we know it was 160, but because it's reasonably close in sales are reasonably close, and that's our discretion. We're just going to use the 150 in this analysis. We're not going to use the 160. So we would have expected our operating income to have been 123,000. Everything else being equal. I forget what was it? It was 128,000. Hey, so we had a great period, right?
Yeah.
Except for the sales. Taking the actual quantity of the year. Yeah, exactly right. So it was supposed to be 128,000. It was 123. So actually we're 5,000 less than we should have earned, given that it was 780,000. And that doesn't even include the fact that there was another 10,000 in fixed costs that we had. So the first thing we'll do is break the that's the master budget variance. That's the master budget. I'm going to break it down into something called a flexible budget variance and a sales volume variance. Okay. Here are our actuals. That was 128,000 in income. And these are the numbers that just happened. We sold 780. We've already talked through these numbers, including the fixed costs here, the real fixed costs. These are the numbers that we were hoping for before the period started. And now we have our flexible budget variance here, which is our actual versus our flexible budget. This flexible budget is this. We flexed our budget based upon the actual units sold. So we have our actual, our flexible budget, and our master budget. And that's the $5,000 we're talking about. And we had a good year because we actually were $5,000 above what our flexible budget said we should have been. We know our fixed costs were a problem here. Variable costs were favorable. Sales, very favorable. Okay, we sold less and sales were favorable. What contributed to sales being favorable?
Higher price.
This tells us we sold it at a higher price. We were $77,000 unfavorable. If price was variable by 15.6, this negative 176,000, what caused this? Price versus volume. So this was an unfavorable 176,000 in volume. Our variable costs favorable. You'd expect that, right? Our volume was lower. And we decided that we're going to compare the fixed costs as even, so there's no change there. So our sales volume variance, the amount of the variance that was due to selling less than we thought we would, was 77,000 unfavorable. But aside from selling less, we did pretty well. We were $5,000 favorable. We need to do that flexible budget to get to these numbers. And the flexible budget is relatively straightforward, right? That's just in actual units and multiply by your standard costs in each of the categories.
Just wonder what the sales volume
Why is the sales volume
what was 77?
why is it unfavorable?
Yeah.
Because you earned 77,000 less dollars than you wanted to. It costs the volume. So it's unfavorable. Unfavorable, think of it as bad. Favorable, think of it as good.
And the example illustrates the flex budget based on the actual sales volume. Can we based on the actual price?
It's based upon volume. You flex based upon the actual volume.
So it's always based on the
So
actual.
the first step in the flexing process is to use the actual volume as the basis to separate out the sales volume variance. And you can see we're going to take these numbers now and go further. Based upon this analysis, would you say anything about who's done well, who's not done well? Did you fire anyone because of this? I mean, this isn't in the text. As I saw these numbers, if you raised a flag for me. Would you have a good talk with somebody?
Well, the sales team is doing a combination of selling points. The average price is better. Oh, the average price higher. That's why they have 5,000.
So you think the sales team wasn't working hard enough to sell? And that might be. That could, that's very easy to come out.
The goals were to,
Could the managers could have set a too high a goal? Anyone have anything else that you stick out of this? Something that I see as a possibility you should explore. If it's possible that maybe the sales manager, beginning of the year, said, we can get more for our product. Let's sell it for $20 more per unit, and told the sales to go out and sell. And then the sales team went out and nobody was buying. They got more per unit, but sold fewer units. There was a strategy shift potentially to try to raise the price of the product, and the market just was not ready to pay that price for the product. That could have caused this.
What if your budget is wrong?
It could be that it could be a lot of different. I'm speculating. It could be you just budgeted off, but somehow they did raise the price. Right? It's clearly they're getting $20 more per unit than expected.
So it hasn't left the cost of goods had gone up. That would have been reflected in the variable cost of goods, huh?
Yes. So yes.
In other words, in that scenario, maybe the manager had no choice but to raise the price because the cost of goods had gone up.
Well, hopefully.
But really, maybe see in that slide.
I would just say to that it's probably not good business to raise your cost to your customers just simply based upon your cost of goods, because you have to understand the elasticity of the product. Will the customers buy at a higher price? The market defines that's the price you can charge.
You're going to go out of business, you can't charge.
Might be.
Is the flexible budget variance equal to the price variance? It is the same.
Is it equal to the what?
The price variance.
The price variance.
Is
You can think of it at the highest level as this is the variance that's due to change to the prices here. This variance, sales volume variance, is the change in sales volume, and this variance is due to the prices. But we have to break it down. It's not we don't yet have enough information here.
Because you say the standard cost of variance can be divided in two parts, subtract variance and counter variance.
Right.
So which is
So you can think of this as volume. For now, think of this as price.
subtract variance
Yeah.
and the cost.
But you'll see, we're going to break it down. So we get this one price variance is going to break down into individual usage and price variances. So you know you can speculate some things here, but it's hard to really know at this point. But it does highlight some things to think about. The next few slides I'll go through quickly. So just follow us for those of you who want to understand these numbers. So the difference between the actual amount and your flexible budget was this 5,000 favorable. This is called the flexible budget variance. And think about what we've done. We've used the actual selling price per unit. So we used actual selling price, actual variable costs, and actual fixed costs, and comparing how they differed from plan, keeping constant the volume, sales volume, at the actual level. The operating income variance is the sales volume variance. You keep everything else constant. Remember, the flexible budget keeps the unit costs and unit revenues constant, and it compares to the master budget. The only thing that's varied is the sales volume, which is why it's sales volume variance. That's the amount that is difference because of the sales volume. You can calculate it if you decide to use the fixed costs at 150,000. So that's your management decision. You can think of it as contribution margin. So if you budgeted contribution margin times the difference between your actual units and your budgeted units. So your contribution margin on the budget was $50 per unit, and we actually had 220 units less than we wanted. So that's how another way of looking at that, 77,000 unfavorable. It's just a different way of looking at the same numbers. This all adds back up to your total of 72,000, which you can think of as the difference between the actual and the master budget, or the sum of your two primary variances. Same thing. Can't do it anymore. Okay. Here's a little chance to do a little work. The Baldwin Company master budgeted sales revenues of 160,000. They budgeted master budgeted variable cost of 48,000 and fixed cost of 52,000. Actual sales revenues turned out to be 180,000. Actual variable cost of 54 and fixed cost of 50. What was the total? This is not, you're not flexing here now. We don't have the volume information. This is not flexible here. What was the total variance? So I'll come back to it. The total variance is not these two, the one above it. And was it favorable or unfavorable?
Probably mean like why they I mean those are just like it's basically no
What do we have? 16,000 favorable or unfavorable?
Favorable.
Right, 16,000 favorable. Okay, pretty basic. Okay. Selling price variance. We'll take that flexible budget variance and now break it down into variances that are due to price and costs and usage. Okay, we've been here, right? First, let's look at the selling price variance here. See that there's 15,600 favorable. It's the same concept. You take your actual sales minus your flexible budget sales, and it's so you have a favorable 15,600. Again, there are different ways of looking at it. It shows us that we sold items for 820 rather than 800. It's your price variable on sales. Okay, so it's pretty straightforward here. Selling price variance. So why don't you compare this to this? Because at that point, you don't know whether the variance, if you just compare these two, you don't know whether the variance is due to the fact that you sold less or you sold it for more money. This tells us that 176,000 is due to us selling less of the product. This positive 15,000 is because we sold it for more per unit. So if you just compare this to this, you haven't figured that out. You haven't broken it down and tried to determine the cause for that variance.
Well, why would you want the flexible budget capture? Like,
The flexible budget captures everything at standard except for the new volume, the actual volume, right? So all the standard costs, per unit, at the actual volume. And so by doing that, it allows you to decompose the differential and try to understand it more.
so if it's also compared the actual volume goal.
The actual volume here is the same actual volume here. This is using the standard volume of 1,000 units. So by using that actual, it kind of allows you some data in between that allows you to decompose it in two directions. That based on volume and that based on price. We have more information now, right? By doing it this way, we know that we sold it for $20 more per unit, but we sold 220 fewer units. try to do this problem. Davidson produces a single product, take deposit boxes. They expect it to sell it at $55 per unit. They were forced to cut selling price by 10%. Variable costs per unit were $32. Fixed costs were $156,000 for the year. They expected to sell 100,000 units, but sales was 5% less. Okay, so there's a lot of data here, a little more complicated. What was the selling price variance? That's what we just worked on, right? The selling price here. How are you going to do it? What's the strategy?
Actual cost minus standard cost and
Actual.
price minus standard cost and multiply the actual cost.
Remember, it's just the price variance.
Yes.
So the cost may not even be that relevant to this analysis, right? Well, you need the cost. Yes, you do. You need it. The strategy, create this. Create your actual, your flexible budget, and your master. And then compare these two. And you only need to do it for the sales line, right? We've given you some variable and fixed costs here, but we're only asking for the selling price. Yes, Jackie? Marley? Jackie? And what? So.
Actual minus flat budget variance. Then a flexible budget variance based on actual sales cost. If you want, reduce the standard cost and multiply actual.
Okay. And the volume
How many of you got it? How many have given up?
The answer, first you know the answer, I think I got it.
I'm not going to tell you the answer. Okay, you want to do it together? Anyone one more time? What was the, when we start with budget, what was the budgeted or the standard volume they were going to sell? What was their budget or standard price? What was their total sale? 500. Okay, let's go to actual. What was their actual volume?
95.
Yeah, the sales were 5% less than budget, so it was 9,500. And what was their actual price?
49.
49 and a half. So what was their actual? 72,000.
47. 2 cases. 470,000.
250. So we know that the total variance now. Let's figure out the two components of the variance. What volume are we going to use for flex volume?
9,500.
Actual volume. Good. What price are we going to use for flex price?
Standard.
55, right? Standard. So what's our total here?
45. Oh, sorry, 94,000.
Can't be. 95, 9,500 times 65.
Oh, sorry, 523,500.
There you go. Okay, so what's the difference here?
250. It's minus. It's
And what's the
unfavorable.
difference here? Favorable or unfavorable?
Unfavorable.
What's that difference here?
79, 70. Actually, no, that's the total. Sorry.
It's
That's the
27.
total.
It's our 7,500.
Favorable or unfavorable?
Unfavorable.
Unfavorable. Okay, so what was the selling price variance for the year?
52,200.
Okay, I mean, you got this.
Which is the selling price variance, right?
Yes.
Because you have a slide that's called selling price variance, and there's two different formulas. What formula?
I think they, you should get the same answer.
No.
Cover this one, this one? Got the same answer here.
Yes, actually.
So yeah, the word problem, I think that's a different question. What was your problem? We'll come back to you in a second. What's the wording of the problem? The standard price was $55. And the 10% cut was off the standard. They sold it at the beginning of the year. They set the price at $55. During the year, they hadn't cut it. Their standard 55, they actually sold it at 49.50. So the standard remains 55 though. This was just the realities of the marketplace. Okay?
I figured out what I
Professor, so what is the meaning of the remaining difference? I mean,
This is the sales volume variance.
sales volume, this is sales price.
Sales price and sales volume.
Okay.
I'm not quite sure what this tells us that we didn't already know. I mean, wouldn't we have been able to predict that if you're selling fewer widgets at a lower price, you're going to sell under?
Yeah. In this case, yeah. But again, it's the additive that this was just an exercise in doing the problem, right? So you understand how to do it. Sometimes you're going to sell fewer widgets at a higher price, and your total revenue is going to be more. If you want to understand what contributed, was it the volume decrease or the price increase? So this one.
Why that the why switch the 2,500 units on sale? Because we use
Because
extra quantity.
because you sold fewer items than you wanted to. That's bad. The volume variance is bad.
That's all. And
Sales volume variance, sales price variance. In this case, they're both bad.
the volume variance and the
Price.
price variance.
Your question, oh, no. The fixed cost variance. You can decompose. You would similarly decompose to the sales price variance of the variable costs and determine favorable versus unfavorable price versus volume based variances. Fixed costs are a little bit different. Our actual is 10,650 more. So costs, when your costs are higher than they should be, that's unfavorable. When your sales are lower than they should be, that's unfavorable. That's the easiest way to put it. You can then break down this fixed cost, and you should, to understand, what's driving that variance. So marketing costs higher, with sales manager salary higher, understand those fixed costs a little bit more. And we'll talk about, this is really chapter 15 stuff on how you manage that. But for the most part, there's not much that you could do as a manager of, let's say, a production floor concerning fixed costs. If there are variances there, not much you can do. Variable costs, it's the same as we did for sales, except your favorable or unfavorable is opposite. You want your variable costs to be low. And we could see that our favorable $50 price base, so we're able to, not material, we're able to actually less per unit, cost less per unit by a little bit. And most of it is due to the fact that we sold less. We needed less than less. Right, so this is more or less zero there. But that just tells you that you had a slightly better usage, cost than the variable costs, but not material. And again, you can figure it out. Were those variable costs better because you paid less for labor, you paid less for direct materials? Overall, you were pretty much on budget here. That's your variable cost variance. then go next level down and figure out your direct materials variances, your direct labor variances, and then you can look at your overhead. Again, overhead is next chapter. There's no data for our example on how to break this down. So let's create an example for direct materials. Ready? The same idea. Actual versus standard, and then you flex in the middle. The top half is going to be the same for the next couple of slides. Hanson manufactures jerk. You need a pound and a half of stuff to create jerk, and it costs $4 per pound. This is your standard. You expect to use a pound and a half at $4 per pound. That's where you put in your master budget. Last month, they needed to purchase 1,700 pounds of stuff, and they made 1,000 jerks, and it cost $6,630 for that stuff, for that 1,700 stuff. What was their actual price paid per pound? To make 1,000 jerks, whatever they are. It doesn't matter what the jerks make.
3.9.
Right? Because you measure jerks by the minute, not by the pound. Because other stuff goes into it as well. We're just looking at the stuff, this thing you're calling stuff. Think of a jerk as like this. What was their actual price per pound?
Do you know?
Yes, sir.
Why there are two? At $4 per month.
This is your standard. Your standard is you need this much to create one jerk, and it costs this much per pound. This is not $4 per jerk. This is $4 per pound of raw material. Maybe I should use this example on something more realistic than jerk and stuff. Okay, what's the price per pound? Actual. $3.90. 1,700 into 6630. Same time. What was their price variance for the month? How do you calculate the price variance? Yes. So this example, that your choice has made this a little bit easy. So what's the answer? 170 favorable. Would have been a more difficult selection. What if I had 170 unfavorable, 170 favorable, and then 150 unfavorable, 150 favorable? You had to be careful whether you used which ones you use. But this is to show you that you use your actual. Okay, so the answer is B. 170 favorable because it costs you $3.90 versus the standard of $4, 10-cent difference, times of 1,700 pounds. Next, same stuff on the top. Standard quantity that we should have used to produce 1,000 jerks is what? Everybody. 1,500. That's what it says right here. So that's B. You use it.
1,000, as opposed to 1.5 pounds per jerk.
Yes, exactly. That's your standard quantity per jerk when we say 1,000 jerks.
We actually usually count too much.
Yeah. How about their material usage variance? What do we use to find the material usage variance? Where do we use the standard? Where do we use the actual?
Standard
price.
Standard price
Actual.
costing.
and the variance is the difference in the quantities. So what's the answer to this? C. $800 unfavorable. $4 per pound unfavorable. 200 pounds. So C. Bringing it all together in the model, we call this the mustache slide. We have a price variance of 170 favorable, a usage variance of 800 unfavorable, and so our total materials variance is 630 unfavorable. Okay? Let's wrap this all up. Causes of direct material variances. A price variance. You could have bought materials at a different grade, quality, by a cheaper material. Looks good as a price variance, right? Where will it show up though? It'll be negative as sales variance. It'll be negative as a quantity variance. So you need to be careful. Just because you have a positive price variance, a favorable price variance, doesn't mean you've done something good. Although you could have gotten it because you negotiated better prices, that would be good. Could have also been because, could be unfavorable because you had to do rush orders because there was bad planning somewhere else. That's not necessarily bad or good for that manager. So you're showing that just because the variance is positive or negative, it doesn't tell you how that manager performed. They're extenuating circumstances. Quantity variances. Again, you could have purchased substandard materials and therefore had to buy more of them. Variances in direct materials could be caused due to labor. You have poorly supervised or new labor that doesn't really know how to use the material and there's more wastage. Or it could be the machinery is getting older, hasn't been maintained right, and and so you're wasting materials because of machinery. So again, you need to really understand the causes. Direct labor variances. Obviously, you can have a rate variance in direct labor because you're getting cheaper labor. You could have a rate variance because you use old standards. You know, it could be an accounting problem. Efficiency variances, poorly trained workers, poor quality raw materials. Just as labor can influence raw materials, bad materials could make the labor have to work harder to get it done right.
I'm just confused why, I mean, maybe it's just a matter of your accepting the definition the way you gave it, but if they actually, I understand they use 200 pounds too many, right?
Right.
But they save 10 cents a pound on the material itself.
Right.
So why wouldn't you multiply the 200 by 3.9 rather than 4? Or why don't you take that? It's a variance. It's not as bad as it's like, yes, they use too much, but they saved on the material. So in other words, what you're saying is the definition of the material is a variance of comparing it.
Right. You want to find the usage variable. You want to take the price out of the equation. So if you would have compared it to the actual price over here, you now your result here would have had both a price component to it and a usage component to it, and you really you're isolating it what through the usage. Exactly. Other things, out-of-date standards. The point of this, all of this, you need to dig in and understand the causes of these variances. You can't just accept there's an unfavorable variance the manager says. Okay, accounting in a standard cost system. I'm not going to go through the journal entries, but you begin following a stage. You begin with the standards, and then you add the variances and subtract the variances. It's a more complicated journaling process, but it has some rich information in it. So, no. There will be no journal entry questions. But some of you care about it, so I show it briefly. But I won't. So some of the homework assignments include journal entry homework. It won't be on the first. Okay? So this all says that there are limitations to using these financial performance indicators. You have short-term information, might extend to short-term decision making. As you said, you know, if you have substandard labor and you need more raw materials, you may not see that. If you're at the beginning of a learning curve, etc. Individual managers, the purchasing manager for direct materials, who's getting evaluated on whether he has a price variance or not, is going to make decisions for themselves, local decisions, not strategic decisions, if you overemphasize this. Of course, because it's backward looking, it's too late, unless it's a sign of something systematic that's going to continue in the future. And systems are complex. Companies have a lot of people that can handle complex systems. So it's important to not only look at financial performance indicators, but also look at non-financial indicators. And one that I'm just mentioning here today, that we will talk about later on in the semester, I think, is customer response time. So not financial now. This is really evaluating the organization as a whole on the ability to get the product to the customer as quickly as possible. Not financial, but if you evaluate this along with the financial indicators, you have a better view of how you're doing. If you only evaluate this, yeah, you can get it done really quickly. Just keep tons and tons of inventory. There's a cost to that. So it's a balance between the use of non-financial indicators and series of things that happen between the customer order and delivery, and manage that critical path to get it down to as short a period of time as possible. Okay,